The stock market is currently closed for the weekend today, Saturday, August 1st, 2026. SoFi Technologies, Inc. closed its most recent regular trading session on Friday, July 31st, 2026 at $16.31 per share. That represents a daily drop of 16 cents or roughly 0.97% on a heavy trading volume of over 56 million shares. In after-hours trading, the stock drifted slightly lower towards $16.21. If you only look at the headlines, you might think SoFi is just another digital bank riding the wave of retail trading. Most retail investors look at the recent volatility around earnings and assume that Wall Street is punishing the company for slowing down. They see a modest pullback after an initial earnings pop and think the growth story is hitting a ceiling. But if you look deeper into the structural mechanics of their business model, the real story is almost the exact opposite. The common expectation among market commentators is that high interest rates and tightening credit conditions would crush digital lenders. The general narrative suggests that without cheap central bank liquidity, alternative financial institutions cannot compete with traditional brick-and-mortar giants. Investors often lump SoFi together with standard Fintech apps, treating it like a pure consumer play vulnerable to sudden economic downturns. Reality tells a completely different story. SoFi isn't just surviving higher rate environments, it is actively using its bank charter to siphon high-yield deposits away from traditional institutions. While legacy banks struggle with deposit flight, SoFi reported a massive surge in member growth and total deposits in its Q2 2026 earnings report on July 29, 2026. The company posted record quarterly adjusted net revenue of $1.2 billion, up 40% year-over-year, and adjusted EBITDA of $357.8 million, up 44%. Diluted earnings per share came in at 12 cents, beating consensus estimates. Yet, despite beating expectations across major top-line and bottom-line metrics, the stock experienced sharp intraday swings. Why did the market react with such indecision? That brings us to the core tension driving the current price action. Institutional traders are weighing short-term capital deployment against long-term operational efficiency. On the day of the earnings release, the stock initially dropped nearly 6% pre-market as algorithms reacted to management's decision to maintain profit guidance while stepping up growth expenditures. Investors wanted a guidance raise, but management chose to reinvest earnings right back into product development and member acquisition. Within 48 hours, the stock rebounded from a low of $15.25 on July 29th back up to $16.47 on July 30th before settling at $16.31 on Friday. This friction between immediate quarterly gratification and strategic reinvestment is creating unique setup dynamics. When you look across the broader market, retail traders often chase high-profile names like Tesla stock, Apple stock, and Nvidia stock during tech rallies. When liquidity flows out of mega-cap tech, it needs somewhere to land. A significant portion of that capital has been rotating into financial technology platforms that demonstrate GAAP profitability and strong balance sheet fundamentals. Let us pause for a quick moment right here. Comment below how many shares of SoFi you currently hold in your portfolio and what your average cost basis is. It helps build a real picture of where retail sentiment stands right now. To fully grasp what is happening with SoFi stocks today, we have to examine the broader competitive landscape of digital finance and brokerage services. Everyday retail investors are choosing where to manage their financial lives. Platforms like Robinhood have dominated the quick trade space with Robinhood Stock Trading, the Robinhood app, Robinhood Investments, Robinhood Crypto, Robinhood Cash Management, and Robinhood Fractional Shares. Meanwhile, legacy giants like Fidelity continue to capture massive market share through Fidelity Investments, Fidelity ETFs, Fidelity Mutual Funds, Fidelity Brokerage, Fidelity Wealth Management, Fidelity IRAs, the Fidelity mobile app, and the Fidelity Trading Platform. On the institutional side, traders who require advanced execution tools naturally gravitate toward Interactive Brokers, paying close attention to Interactive Brokers trading, the Interactive Brokers platform, Interactive Brokers fees, setting up an Interactive Brokers account, and conducting Interactive Brokers stock trading. Furthermore, automated wealth management platforms like Schwab Intelligent Portfolios and other intelligent portfolio options have made self-investing and online investing effortless for millions. Where does SoFi fit into this crowded ecosystem? Through SoFi Invest, SoFi Investing, SoFi ETFs, SoFi Robo-Advisor, SoFi Active Investing, and the broader SoFi trading platform, the company isn't trying to beat brokers at high-frequency trading. Instead, it's building what management calls the financial services productivity loop. The goal is simple: acquire a customer with a high-yield checking account or student loan refinance, and then cross-sell them into an individual brokerage account, credit cards, mortgages, and wealth management tools. In Q2 2026, SoFi added 1.1 million new members, bringing its total member base to 15.8 million. More importantly, existing members opened 51% of all new products during the quarter, up from 43% in Q1. This metric proves that cross-buying is accelerating. When a customer uses one app for their checking, credit card, and online investment needs, the cost to acquire additional revenue from that customer drops towards zero. That structural cost advantage is something traditional banks can't match without massive software overhauls. Let us step back for a moment and look at the history of how SoFi reached this stage. Founded initially as a student loan refinancing project, the company spent years operating under the constraint of being a pure marketplace lender. Back then, it relied on third-party warehouse facilities and credit markets to fund its loans. When interest rates shifted, funding costs fluctuated wildly, creating significant margin uncertainty. The inflection point occurred when SoFi secured its national bank charter. That single regulatory approval transformed its entire balance sheet. Suddenly, SoFi could capture retail deposits directly from consumers, offering competitive interest rates. Those deposits provided a stable, low-cost funding base to originate personal loans, student loans, and home loans. In the second quarter of 2026 alone, total loan originations reached a record $14.8 billion, driven by $10.7 billion in personal loans. In addition to consumer lending, SoFi's technology platform segment, anchored by Galileo and Technisys, acts as the underlying infrastructure for numerous other fintechs and enterprise clients. This B2B division generates recurring fee income that is entirely independent of interest rate fluctuations. By diversifying revenue into capital-light fee streams, SoFi insulates itself against the cyclical shocks that typically hit pure lending businesses. Looking forward, what are the primary scenarios, catalysts, and risks that investors need to monitor over the coming quarters? The ultimate driver of stock performance will be the rate at which SoFi can scale its non-lending revenue while maintaining strict credit quality. In a bull scenario, central bank interest rate cuts could reduce borrowing costs, accelerating consumer demand for personal loans and mortgage refinancing. Lower rates would also boost equity markets, driving higher trading volumes across SoFi Invest and boosting asset management fee revenue. If SoFi continues to expand its enterprise tech network while keeping credit losses near historical averages, margin expansion could accelerate rapidly, pushing the stock back toward its previous high valuation multiples. In a bear scenario, a sudden downturn in consumer credit quality could lead to elevated loan default rates, forcing SoFi to increase its provision for credit losses. Furthermore, intense competition among investing sites and mobile platforms could force SoFi to spend more on marketing to maintain member growth, squeezing short-term profit margins. If retail depositors begin moving funds back into traditional institutions or treasury bills, deposit growth could cool off, increasing funding costs for loan originations. The contrast between market expectations and operational reality remains the defining narrative for SoFi. The market often treats SoFi like a volatile speculative tech stock, subjecting it to sharp price swings based on short-term macroeconomic noise. However, the underlying financial data demonstrate a rapidly maturing financial institution with strong revenue growth, high deposit retention, expanding margins, and a sticky ecosystem. For investors seeking investment help or evaluating options for an individual brokerage account, understanding these underlying fundamentals is critical. Whether you choose to invest online through established legacy institutions or newer digital networks, evaluating how effectively a company converts user growth into long-term cash flow is the key to sustainable performance. In summary, Friday's closing price of $16.31 reflects a temporary pause in a broader multi-quarter transition. While short-term trading sentiment may fluctuate with interest rate speculation and macro indicators, SoFi's ability to attract millions of members